Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show, we do a deep dive into different industries using weekly charts to see what's happening on a long timeline. Please follow me on Twitter at SchnellInvestor, and you can also find my blogs on gregschnell.com as well as StockCharts.com. So we had huge rallies in the last 2 days, pumped up, and then unfortunately on Tuesday's rally we started the day high and then finished pretty much unchanged on the day, so gave up the whole thing. Today I want to cover off shipping and China names after I get into the S&P 500 for a little bit. And I just want to set the stage so that everybody kind of understands what we're trying to deal with. So each rollover is another wave of worry, and I'm going to point out what that means, and then potentially how to trade through that. It's a little difficult, I must admit. Shipping stocks, there's two things on shipping. One is that if shipping stocks are starting to improve, maybe there's more stuff going on. And then the second component of that in the case of tanker stocks is they specifically might go up because they're storing crude. So that's an interesting trade. The next area is China stocks. If China is actually coming out of this, every couple of weeks we want to dip in and just see what's going on in China. And the charts, there's a couple of pages or a couple of charts that I like, but I'm not quite excited about them yet, but I want to share them with you and make sure you see what's going on. Okay, just a screenshot here. So we've got the U.S. with 400,000 cases, and just to set the stage, that's why the market's under so much tension here. If you're watching this video in the future, you'll be able to just kind of relate why we're talking about what we're talking about. So don't need that tab anymore. Okay, what I want to jump into here. This is the S&P 500 on a short 60-minute time frame, and we had a huge move down from 3150 to 2191, so pretty big. And then we rallied up, and then we pulled back, and we rallied up. So now the question is this an A, B, C correction? And what happens in wave theory is that you have, in a primary wave, you'll have waves down and waves up. And then depending on what the major trend is, if your major trend is down, then you'll have 5 waves down and 3 waves up. And then if your major trend is up, you'll have 5 waves up and 3 waves down. What we don't know, I mean, this was so big, this was 31%. So you have to assume that's our primary direction. And then the corrective wave should look choppier. And that's what we have so far. This was a pretty smooth run down. But then we get this corrective wave where we go up and then we pull back. And then we go up again, trying to get more people involved, and then we break down. So this is critical to understand wave theory. Doesn't mean you have to become a wave technician, but what it does mean is if you understand that simple thing, that primary waves are 5 waves and corrective waves are 3 waves, that's important. And then corrective waves can be simple, A, B, C, or they can be more complex where they chop around a bit more. If is the right answer, if we can map them out easily, that's helpful. But as an example, on the bottom of the 09 low, I think everybody was expecting a different wave formation and another low for the people who really counted Elliott wave. And then that didn't happen. So I don't want to get too hung up on it, but essentially we had wave 1 down, this was a corrective wave. Wave 2 down, this was a corrective wave. And then wave 3 down, wave 5. So 1, 2, 3, 4, 5. That probably doesn't even count because wave 3 cannot be the shortest. It doesn't have to be the longest, but it cannot be the shortest. Anyway, I'm not a big Elliott wave counter, but what I do want you to understand is that just from that simple description, we've kind of had a 3-wave corrective move. And so we need to think about if the market was going to correct again, where would it do that from? And typically it's from this level. Now, I got a whole bunch of charts set up here, 10 per page, and we're just going to go look at a few different views of the S&P 500. But I want to instill a couple of key messages. So one is, here is our momentum, the PPO on a 60-minute chart. And again, normally in up years, regular markets, you wouldn't look at a 60-minute chart on my show. Um, but what we've had is the moves are so big. Like this little move here is 3%. That's a good month. 3% was an absolutely massive move inside the day, and then this yesterday was 7%. So these are huge changes. So from this is 10% from Friday to Tuesday morning, and uh, that is pretty important to understand. So if this was a bear market rally, and let me just say, I think it is. So what we want to be worried about now is where do we get out? And here was what we have. So we have an uptrend in momentum. We have a high in momentum here, and now we're making a slightly lower high. I won't call it a huge difference. If it just kind of rolled over down in here, that would have been a huge difference. But it physically had a pretty good surge, and most of it, let's face it, was off of the overnight gap. And the overnight gap does a couple of things. It forces people who are short to cover. And then after that, then the day goes on and proceeds into a normal course of trading. But a lot of times you'll see the gaps in the overnight, which is fine. So as an example, coming off the low here, that Monday low, and then the huge gap on Tuesday, and then it ran up all week. And then up here, it started to look like it was going to get a little weak. Well, it had more juice left. So it's not so easy. In hindsight, it looks easy. It's much more difficult in real time to kind of call it as it goes. But we have a couple of other trends on this chart, and I'm just going to spin down and mark the bottom here. So one is we have a trend on, the VIX. And if that trend was to break, that would be important because that would kind of tell us that we're surging back up again, especially if it got back above this blue line, which is the 20-period moving average. That would make me worry. We also have a trend here. And as long as that trend line holds, that's a good thing. And then we have the momentum trend. And if the momentum trend is going to break, I do not want to see this break because this goes all the way back. Our lowest point in momentum was the 13th of March, and this was our low on the 23rd of March. So what happened is our momentum was actually, I'll call it, well, still negative, improving to being less negative, while price was continuing to fall. So that's the divergence we're talking about. So here the price is moving down, and this is making a higher low, and here price is making a higher high, but we're making a lower high in momentum. So we want to keep watching this relationship to see how it works out. And again, we're doing it on a 60-minute chart because of the volatility, not because that's where we want to trade. Now the good news is this blue line represents the 20-period moving average on a daily chart, and it's starting to turn up. So that's a very bullish scenario. And if it was going to pull back to this blue line and then bounce up here, that would still be all okay, and we would try to remain bullish. Now, the question here is if by the time let's just say the price wobbles down a little bit more tomorrow and comes down to this trend line, and we get down here. When we get here, this is a pretty critical spot. This will be as critical as it was here, and we made 10% in a brief period off of that low. But the point is, if we roll over here and start to lose our momentum, at the same time we'll be losing the 20-day moving average. That would be one of those really worrisome points. And now I want to get into why just that point might be so worrisome. So let's get out of this chart and go into some different time frames. So over here, so every time I write an article or create PowerPoint slides or something like that, or I'm explaining a story, I'll put slides together and I put them all in one folder. So one of the things that I want to point out here, this is 1987, and then we're going to go to a few other time frames here, but this is 1987, and the reason I want to show it is a big, massive drop. And then this was the original spike in October, and then kind of chopped around 1, 2, 3 waves, and then we went up, and then we got up here, and then we fell back down. And this was a 20%er, and then we fell back down, and we went all the way down and tested the lows. So what we just did on this chart was here's the rally, and then this rally was up 20%, and then we pulled back 6, then we went up 10. So we've had a pretty nice rally, but the question is, how big is it? Well, our point is, or my point would be, this is what happens off big drops like we've just had, and you get a 20% bounce, and then on your 20% bounce is going to pull back and then try and get through again. And if it can't get through again, then it rolls over. So the real question is, was the bounce we just had this kind of shimmy shake, and are we now set up for this? And if that was the case, we're going to lose all of this 20% we've just gained, and it's literally going to roll back. Now, this is, again, basketball theory, where the ball bounces, it bounces up, and it makes a pretty high bounce up, and depending on how far it's fallen from, the higher, the longer the fall, the higher the bounce, right? And then each one of these reverberations is just kind of getting the ball to lose some of the momentum it had, especially downward. And then we finally start to roll, and then we make smaller waves, higher, higher, higher. And, this is 4 or 5, 6 months later. So that's the kind of price action we want to watch for. But I want to explain this big green line here, which is the 200-day moving average. And in general, uptrends stay above that, downtrends are below that. When you get the changeover above that, so here's the good news. You got the signal, made new high. What's the first thing it does? Go all the way back down, and goes right past all of the bullish points you were just thinking you had. Gets you all worried. And there's a small uptrend here that tried to hold and did a good job. And when that uptrend holds, obviously that's very helpful. And so you start to rally out of the hole. But then, so where this line was support here, then kind of resistance all through in here, and then it becomes support again and takes off. Okay, so let's go to 2008. What you see happen in late 2007, was that you had a high in July, pullback, and this is a meaningful pullback. It was 10 or 15%, and then it bounced back up to the October 9th high, and then pull back down, and we're on January 22nd. And so then off of this big low, you get this bounce. And if this is 20%, this is like 7 or 8%, right? That's just kind of standard. And then you wobble up and you pull back. We did that. And now we've wobbled up. And so we're trying to figure out where we are in this rhythm. But the important thing to think about is this part. We're under the 200-day moving average, and it's down sloping. And that's typically when it's down sloping, bad things happen under the 200-day. Okay, so I just have to click in on this chart, and what I want to show you here is I just want to extend this out. I have it elsewhere as well. But what you see is this 200-day moving average became resistance all the way along, and not until we started to get above it, and then what happened? It shook everybody out again, and then it took off to the upside. So we want to think about the moving average as helping us decide whether we should be more optimistic all the time or less optimistic all the time. And sorry, optimism is a problem. I mean optimism in terms of the stock market performance, not in terms of the economic turnaround or in terms of people getting healthier, all that kind of stuff. I'm talking specifically stock market performance. When you're under the 200-day moving average, you really do have a weight on your shoulders and you're trying to shake it off. Now, the problem is the economic numbers are dire. I mean, we're looking at unemployment of 20%, blah, blah, blah. So with all of that kind of momentum, and we get a sudden sharp rally in here, and I want to be bullish because the Fed is trying to push us to be bullish and all that kind of stuff. I put out a newsletter yesterday and I said, look, we've had a follow-through signal, and you could start putting trades on and seeing if they work. And I put some trades on Monday morning. I put some trades on. I didn't put any more trades on today. I took off a couple trades today, and some of them are still flat after the gap up Monday morning. They just didn't go anywhere, and then other ones are actually losing a bit of money. And the two I took off were really fast movers and made a nice trade very quickly, and so I just took that off. Now, you're sitting here and you're looking underneath this 200-day moving average for where you are. We're quite a ways away from the 200-day in our current situation. This is back in '08. But you get up here, and just when you start to think you finally got a rally, it gives up, and then finally gives up, and then a couple months later goes down and tests the low. And then it rallies out of the hole, and then it starts to fall. The difference that we have here was this was kind of a slow burn where banks were starting to get weak and mortgages were starting to fail. We don't have that. We have a very clear visual image of how ugly things are, and typically we keep having to downgrade our optimism. So we're in a very shaky part, and if the market was going to give it all back here, what you want to do is take money out. So put on a trade, set your stop underneath it, it rallies up, you make some money, and you either let it ride for a day or two or 10. And if it starts to fail, you just want to take your profits because you're under the 200-day moving average and you don't want to give them all back again. Okay, so it's that setup that we're under the 200-day, and we've seen this movie before in bad bear markets, and that's how it usually goes. So you don't want to try and be the savior who says, I bought low, I'm just going to hold, because that strategy, you'll find out, is quite expensive. Okay, just want to find a couple more charts in here. I have too many. Okay, this is the one I want to find. Okay, so this is 1987, and I showed you that we stayed under this 200-day for a while. Now, this is the period in 2002 and 2003, and look at what happened. This thing was literally, every time we got close to it, it failed. Now, we didn't have to get close to it. We got a rally, and then it failed, and then a rally, and we didn't quite get to it and fail. We don't have any clue how close we get to the 200-day. But when we get to the 200-day, there's going to be a lot of worried people if we can get back up that high. So what we want to watch for in general is what's the market momentum like, and when it starts to fail, that's a pretty important clue to us. So what I want to show down here on this PPO, so again, this is a daily PPO indicator, and I was showing you the 60-minute indicator before, but we could quickly go to a 60-minute chart. But what I want to show you is the PPO barely gets above zero and then rolls over and fails almost all through here. Then we have a huge rally. I would say we just had a big one, not quite this big. This is very big on a daily chart and took a whole month. We're doing everything at light speed this time. So the moves that used to take, in this case, to get down 20% used to take 4 or 5 months. We did that in a month. The move up that used to take 1 or 2 months, we've done that in a week and a half. So everything seems to be compressed, and I don't know if it's because of the severity of the economic situation currently, or if it's just computers have sped everything up for us. I don't have that answer. But what I want to say is when the PPO rolls over and you start to lose momentum, so let's just draw an uptrend across the lows here, pick mid-February or early February, go up onto the chart here. What you see is we've bounced up, we kind of hold, and then we start to fail. And look at what happens. It literally starts waterfalling. So we do not want these uptrends in momentum to fail. Now, I've also got the 2007 picture here. And again, this is zoomed out and you see the 200-day moving average. And now I want to show you the current picture. So here we went below it in 2018 and then bounced above it and it became support all the way along again. That's perfect. Wobbles around the 200, falls hard, rallies up, and now we're a long way from 200. There's nothing that says we get all the way back to the 200-day on our first attempt. So, and we saw that in 1987, right? We saw the big pullback, and then it spent a long time down here, like 6 months, before it even tried to get back up to the 200-day. Okay, let's go up and look at the 1-hour charts because that's what I showed you originally. And the point I want to make on this 1-hour chart is that as you're coming down, look at the PPO waves here. So you get a wave up, a wave down, a wave up, a wave down, a wave up, and it's higher. So each one of these is momentum. This is feeling pretty good. And then you can draw a trend line under your momentum wave. And when that starts to fail, especially near zero, you want to be cautious. So let me just say that we've come off some sort of a horrific slide like this. This is roughly 2 months. We did it in 1, but we have this big pullback. We rally up, and it's a good percentage of it, a third or a fifth or a half, something like that, rally up. But what we see on the momentum waves is they're starting to get shorter. So let's go back here and get, this timeline just so the momentum wave is in the same sort of scale. Let's just change it to 4 or 5 months. And what we see is that same sort of momentum wave building over a period of time. Again, go back and check here. So the same momentum wave is building. And what we want to watch for is when they start to break down and especially go back below zero, to be very, very cautious. And even in the downtrend here, look at some of these big spikes you lived through that were a week long. This second part of the second phase would be the big wave three I talked about after you have your corrective wave sequence of three. So 1, 2, 3, all of a sudden it fails and you start to roll down again. So that's the backdrop of kind of what could potentially happen. And the only reason we keep comparing now back to these times is because this is when the market broke down. We had serious economic damage. We had unemployment spiraling. We had mortgage issues. We had a whole bunch of stuff. Banks get weaker. We want to keep watching what's going on. So I think Bear Stearns actually, this was Bear Stearns failing, and then the market rallied off of that, and then it collapsed after that. So it might have. Yeah, it might have been in February. No, I think it was May. Anyway, I can't remember the date. But I know right after they failed, the market rallied quite a bit. Anyway, the point here is that once this momentum trend starts to end and you start to fail and go back below zero, you do not want to be exposed to the market, or you at least want to have a hedge against your position. So we want to watch this very closely and make sure that if it's going to fail, we're ready for that. Okay. So that's my pitch on the S&P 500. We talked quite a bit there. So I'm going to quickly cover off, maybe I'll cover off the shipping stocks first. And the point I want to make on these is very quickly, they're still all diving and they're not even bouncing as nicely as the index is. So this is dry bulk shipping. You know, that doesn't look like it's starting to improve yet. This is Braemar Shipping Services, really nothing going on. Performance Shipping, that's a terrible chart. And the reason the chart looks like this is they had to keep doing 2-for-1 splits, 1 for 7, 1 for 7, 1 for 3, 1 for 7. So their stock got so cheap, they had to take 10 shares that were in the market and make it 1, or 7 shares in the market and make it 1. And they had to do that so many times during that downtrend in 2017 that the chart gets all smudged like this. Okay, Diamond Shipping recently IPO'd, still living in the bottom corner, no real sign yet. Diana Shipping, same thing. Eagle Shipping, same thing. Genco. So I'm not seeing the heartbeat that I want to see just yet on some of these. Here's Shipping Holding. We want to look for some specifically that say tankers. So this is Global Ship Lease, and you can see still not much action there. Linear Energy, a natural gas shipper, you know, a wedge building, but we would also call this a bear flag. So you've got this downslope, then you build the wedge, and then you get an equal move down. Hopefully not. That would be horrific. But here's Nordic American Tanker Shipping. And what you see here is that the chart fell into that May low, had a big rally out of there, and has already given half of that back. So from 5 back to 350. What we want to watch for on that chart is for this to bounce off zero and start to head higher. If that's going to take place, that's very bullish. And again, the same thing on that PPO. You see this trend coming up. It's now bouncing at the highest level it's bounced all the way through here. This could be a great place to get on board, but you want to make sure that if you're wrong, you know where you're wrong. So let's just say you bought it at 346. The 200-day moving average is at about 313, or call it $3. If you get anywhere under that $3 level, you probably want to let somebody else own this in this period of volatility and take a small loss now rather than a big loss later. Okay, because you're trying to find things going up, and if they aren't going up, that means you don't want to own them anymore. Ship Finance Company, basically big candles, but nothing over the last 2 weeks yet. We're only day 2, but Schnell Maritime Holdings, that's just an ugly chart. You never want to own that. Sino Global Shipping, that's an ugly chart. You don't want to own that. Tough Box Ships, don't want to own it. TK LNG Partners, so here's one of the companies that gets into this stuff. And TK LNG is natural gas, bouncing up to this $10 level. Again, didn't do much last week, even though it was a bullish week in the market, and didn't do much, well, we were down 2% on the indexes last week, so this fell a little bit. And then just trying to hold in here, but it definitely needs to get through $10 to get me interested. Here's TK, and they have a couple of divisions. Down here in the bottom right-hand corner, still falling. don't really like it yet. TK Tankers, again, had that same spike we saw in that other tanking company. And then what we want to see there is that this tanking operation, again, starts to turn up. So can it hold the 200-day moving average or 40-week? And if that's the case, very bullish. Okay, so I just want to quickly go over to the China stocks, and we're going to select a few out of here. So let's go select some of the big names. NetEase is a good chart. What we like about it is continuing to make higher highs and higher lows, bounced off the 40-week moving average after testing below it in early March, not with us, with the late bounce in late March. And it's just trying to hold around the 50-day moving average. Now, one of the things you'll find is that all of a sudden the 50-day will become resistance and it will ride it down or ride it up. So we want to watch that. And if it can't stay above the 10-week or the 50-day, that's a problem. It has broken the uptrend in momentum, but it looks like it's still trying to turn above zero. So that's kind of bullish, and we just don't want to let it get away. So if it gets away, I think we're going to let somebody else own it. Okay, Tencent Holdings, another big one. And then what we want to do here is have this sideways movement. Again, if it could finally break out of this zone, that gets pretty interesting. It's trying. I don't want to put it down. It's trying. Another big one is JD.com. And JD has a nice upsloping trend, but we can see it's starting to break this uptrend in momentum. And that to me is a concern. Now, it doesn't have to be a concern, but it's definitely a place I want to watch, because if this is going to start to fail and doesn't turn higher, this is exactly how things start to break. So you have an uptrend over here, starts to wiggle, and then it just slowly wears you out and takes you down and whatever, wobbles down, and then you kind of get going. But the bottom line is a year goes by and you haven't made any money. So you've had the risk of being in the market, but you haven't had the success of making some money while you're there. Okay. I want to cover Alibaba. Alibaba, where did you go? Can't see it. Okay. So Alibaba has this big sideways consolidation for multiple years. If we envision Alibaba to be something like an Amazon, if this chart is going to turn higher, this is exactly where we want to buy it. Okay, we want to buy it with the PPO trying to bounce above zero. We want to buy it staying above this horizontal trend line and getting back above the 10-week moving average. Full stochastic starting to turn up. Scooter ranking says it's one of the better stocks in the large caps or mid caps. And it's got an uptrend in momentum and relative strength. So between all of these things, this chart is set up, but it hasn't started to take off yet. So that is a great example of what we're looking for, and now we just want to watch it very closely. And if it, as an example, if things in China were going to start to take off, this is probably one chart, much like the Amazon chart in the US, that when they start to move would be wonderful to watch. Another good one down here is Pinduoduo. And this chart IPO'd in 2018, working its way higher, has a downtrend here, and this week, and again we're only 2 days in, has started to accelerate up and out of here. PPO is trying to turn, so this is a good example of something that might actually work out for us. So if we get that sort of push to higher ground, this is the type of chart setup that we want to watch for. It broke above our 38.14. To me, I would buy it in here, and if it started to fail back down with, let's say, the overall S&P started to fail, then I want to take this trade off and not risk falling apart again. But as long as it's trending higher and staying above the 10-week moving average, then to me, that's a trade worth having on. So hopefully those give you some ideas. The shipping stocks, I still want to wait a little bit more, and the China stocks, I'm not quite ready yet either. So thanks for taking the time to join me on Market Buzz. Market Buzz airs Wednesdays at 10:30 a.m. Eastern Time. You can also see the recording on StockCharts TV YouTube page. And if you get the chance, head over to gregschnell.ca. I'm starting to post some stuff over there, have a new blog over there. Thanks for listening. Have a good week. Bye-bye.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.